U.S. natural gas futures dropped about 4% to $3.34, weighed down by steady production and a shift toward warmer November forecasts. Early in the session, prices found brief support after weekend models turned colder across the eastern half of the country for November 4th to 6th, prompting a stronger Monday open. But updated outlooks now point to above normal temperatures through November 11th, triggering renewed selling pressure. The expiration of November contracts has also contributed to volatility. Meanwhile, production remains robust at roughly 108 billion cubic feet per day, near a 3-week high, while record output earlier this year enabled storage levels to climb well above seasonal averages. As a result, the winter contracts underperformed and saw some selling pressure due to a slight moderation in the near-term temperature outlook, especially for the November 3rd to 8th timeframe. Natural gas ETFs, which hold winter contracts, did even worse due to some additional selling pressure. UNG slipped about 4%, while the leveraged 2x fund BOIL dropped roughly 7%, showing growing market caution as we head into the winter season. U.S. electricity generation climbed 4% year-over-year in the week ending October 18, while LNG feed gas flows held steady at 16.6 billion cubic feet per day, up 1.5% from the prior week. Though these indicators reflect a healthy demand backdrop, they've done little to alter the broader market balance. With supply remaining abundant and consumption growth only modest, bullish sentiment continues to hinge largely on short-term weather fluctuations. Natural gas futures are under pressure after breaking below short-term support near $3.40. Momentum indicators suggest there's about a 60% chance that prices could test the next key support around the 50-day moving average at $3.20, and a 40% chance they could fall further toward $3.10 if bearish sentiment continues. On the upside, initial resistance sits between $3.50 and $3.55, with roughly a 35% probability of a sustained breakout. A move above that zone could trigger short covering toward $3.70, though that scenario only has about a 25% probability. Overall, with prices trading below the recent trendline and weather forecasts turning warmer, the near-term bias remains bearish to neutral, unless colder weather or a drop in production sparks renewed buying interest. Don't forget to leave a comment and check out the ads to support the channel. See you in the next one.